Discover the psychology of successful investors in this session with Jonathan Baird. Welcome to Awakened Titans podcast with Lily Patrascu. Mind-blowing conversations with influential business titans sharing how you can manifest abundance, love, joy, success through quantum awakening, quantum manifestation, quantum healing, quantum miracles, exponential business growth, and innovative products and services. Now, Jonathan Baird is the publisher of Global Investment Letter, and he has a long career as a money manager in which he managed several number one ranked funds, the last winning a Lipper Award for being the number one ranked global equity fund in Canada in 2010. You can find more information on his LinkedIn or on www.globalinvestmentletter.com. Now, the first question is, how important is emotional discipline in investing? And how do successful investors manage emotions like fear and greed?
Oh, thanks. It's very nice to be here, Lily. And you've touched on what I think is probably the most important aspect of successful investing. And I suppose psychology could be extended to just a lot of aspects of our general lives as well, in terms of how we manage our own human psychology. With the idea of addressing investing, particularly, ironically enough, human nature has wired us not to be good investors, because a lot of what we think of as intuitive behaviors ultimately does not really work out very well in terms of producing good investment results. One of the hardest things for people to grapple with is to fight the tendency to go with the herd, so to speak, in that you have to cultivate a sense of skepticism and be prepared to adopt a point of view that's counter to what most people will be doing and what you'll be hearing in the media and from friends and family and so on. And that is not easy to do. And I must say that, I've learned a lot about human psychology, particularly with investing, just through experience. But I also have to say that I've probably made every psychological mistake over the years, at one point or another, mostly early in my career, because we're all human beings and I'm certainly all too human. And what I can talk about in terms of what to look for is definitely a product of hard-won experience.
Thank you. And can you share specific strategies on how investors can stay rational in the face of volatile markets?
Well, one thing actually that was an object lesson that occurred to me a couple of Christmases ago is we had a party and somebody was talking about Tesla, the electric vehicle company, and they just loved Tesla, and they were giving me a million reasons why Tesla stock was going to go to the moon. And I didn't attempt to argue with them, because you can't argue with people with that firm point of view. But one thing that struck me was that was a perfect example, is if you're going to buy an investment or sell an investment, if you're a short seller, that you should always have a reason why you would change your mind. So to that fellow that was the Tesla enthusiast, I would have said to him, what would make you decide to sell Tesla, or what are the potential threats or obstacles? And that's true of any stock or bond or any asset, in general. And certainly, ironically enough, when he talked to me about Tesla, it was $400, and it's gone down substantially since then. That's not to say that Tesla is a worse company than it was. It's just that the stock market is not always a reflection of the true worth or merits of a company.
Thank you. Do you find that emotionally attached investors that are emotionally attached to a particular investment tend to lose more than those that are able to kind of rationally think about, okay, these are the reasons why I should invest in this, and these are the reasons why I shouldn't?
That's been my experience. And once again, it's a powerful psychological bias that we have wired within us. We fall in love with a particular stock, or another good example are people that are gold bugs that love gold. And I have nothing against gold, but I treat it like any other asset. And so when I think it's going to go up, I'll buy a position. When I think it's going to go down, I'll sell the position. But I have encountered gold bugs that will just buy gold, and, even 30 or 40 years ago, and they just bought it. And unfortunately, even though gold is doing well now, people that just bought gold and didn't really respond to the price of gold or the circumstances, they ended up incurring a huge opportunity cost because gold performed very badly for decades relative to, let's say, common stocks and so on. There's a time and a place to buy and sell every asset. And part of cultivating trying to be as an objective and a dispassionate investor as possible is trying to recognize that and to step back and try and view things within context, which is why I use historical precedent and consider geopolitics and so on in terms of my own investing activities. It helps provide me with an investment context and helps to try and mute my own psychological biases.
Thank you. I'm getting from what you're saying that first, try not to stay emotionally attached to a particular stock based on irrational factors. And second, get to know the important factors that will affect the investment. For example, through your global investment letter or other sources to make sure you're taking the right action at the right time. Am I right in saying that?
Well, you made a very good point about identifying the key factors that move particular markets. That's very important. And that's something that I didn't know when I was 25, but I soon recognized managing money is identify what is going to influence prices, whether it's interest rates or whether it's industry specific trends or geopolitics. For instance, oil. If you're an oil investor, you should always be closely attuned to geopolitical developments and so on. And certainly that is one of the things that I do try and impart in terms of writing the global investment letter, which I've been doing for over 7 years now, is I attempt to share my own experience and investing activities with subscribers, with the idea being that you don't necessarily have to do what I'm doing, although I show you what I'm doing, but I'm attempting to provide experience and education for people to make their own investment decisions and to be better investors themselves. And certainly a key part of that, and is one of the things that I focus on, is attempting to identify the key aspects that move markets. And whether it's stocks or bonds or whatever, they're all connected. And one of the things that I also try and impart to people is that it's important to, if you're a serious investor, try and look at as many markets as possible and learn about them, because they all, in some way or another, will influence each other.
Thank you. What role does risk tolerance play in investment success? And how can investors assess and improve their own risk tolerance?
Risk tolerance is a key aspect of investing. And one of the things that I like to say is that for the years that I've been a money manager, in terms of talking to clients and so on, everybody is more risk averse than they say they are. That's sort of a rule of thumb, is that they'll, how many times they say, oh, I don't mind volatility. All I do is want to make money. But if the market starts going against them, or they see their investments are down for a month or two, that they can get quite rattled. So risk tolerance is very important. One of the things that I advocate is when you buy an investment position, set a price that if it goes down to, you'll sell. And that price is basically a reflection of saying, okay, this idea is not working for whatever reason. Sometimes you can be buying something for all the right reasons, but circumstances just don't work out. And it's better to take a small loss on a position than a large one. So one thing that I talk about and advocate in the global investment letter is something what I call protective sell prices. So if I'll buy, investment X, at the same time that I buy it, I'll also talk about at what price I would sell it if it reached that price. And so the idea is over time is to try and maximize your gains on your winning positions and minimize your losses on your losing ones. And if you can do that, you can actually make money being right less than 50% of the time. Now, I hope to be right more than 50% of the time, but you see my point.
Yes. How do successful investors approach risk differently versus others, aside from what you've just mentioned?
I think that one thing that professional investors will do, and that retail or private investors will not, is they'll pay attention to how correlated their various investment positions are. For instance, if you own companies that are all related to one industry, let's say oil or something, you're basically making one big bet on oil. And so you're not getting the diversification that you probably need to do. So one thing is to look for the correlations between your holdings and try and diversify them so that they're not all going up necessarily at the same time or all going down. Because like I say, if you're got all your eggs in one basket, that's fine, except you have to just be aware that if something happens in that one area, your losses could. But of course, one of the ways I try and address that, and once again, is using those protective sell prices and so on to mitigate losses. And also, we all just have to be aware that we live in an uncertain world by definition. In every aspect, probably, of our lives, there's a good deal of uncertainty, with very few exceptions. And so if you recognize that, then it makes it a bit easier to psychologically take the steps that you need to do to deal with the volatility that's inherent in markets.
Thank you. How do successful investors balance long-term goals with short-term market volatility?
Well, that's a very good question. I think the long-term goal should be a superior compound return, with the idea being that you should be looking at the long-term result as opposed to short-term results, and not to be too rattled by whether you have a bad month or a bad year or what have you. On the other hand, it is important to look at short-term developments in markets. And one of the things that I do with my approach, which incorporates using fundamental and technical analysis along with the risk management steps that I take, is to try and maximize results by recognizing when markets are no longer rising. To give you an example, I have a couple of core investment themes that I feel very bullish about in the long term, but I don't always own positions in those themes. I will, as long as they appear to be rising at that point in time. But if we have a market pullback or something happens, even though I might be keen on the position long term, I'll step back until a more favorable buying opportunity presents itself. A good example of that is back in early 2020, I recognized the threat that was posed by COVID. And in the February and March issues of the Global Investment Letter, I recommended to subscribers that they sell their positions in equities and so on because of the impending threat of COVID. And that actually, worked out very well because people were given a warning ahead of the crash in March of 2020. And that was a situation where I thought that the risk reward of holding positions, even in investment ideas that I really liked in the long term, wasn't in my interest in the short term. But I subsequently repurchased positions later on. So it's a bit of it's a bit of a two-edged sword. But certainly investors should, if they're active investors and serious investors, you have to pay attention to current and impending trends as well.
Thank you. What are the most common cognitive biases that derail investors? And how can one become aware of and combat these biases?
Some of the common ones, we talked about sort of falling in love with stocks and so on. Another one that I see a lot is somebody will buy something and then it'll go down by 25 or 50%. And they'll decide, I'm not going to sell it until it gets back to my purchase price. Well, there's no guarantee it will get back to your purchase price or when that's going to happen. So we all have to remember that the stock or the bond or whatever it is that we're buying doesn't know we own it. It's going to do whatever it wants to do. So and that is such a common one. And it's illogical when you think about it, but most people have a great difficulty admitting they were wrong or making a mistake about almost anything. One thing a good investor has to do is to be prepared to admit pretty quickly when they're wrong about something. Because being wrong about anything is not in itself a bad thing. I mean, if you never did anything, you'd never have the opportunity to fail or be wrong. So that is a key psychological characteristic to develop. It's not always easy. None of this is necessary. As I said, none of this is easy because we're not wired as animals to feel this way. But with experience and you can go in, there's various interesting books on human psychology and particular investment psychology that might be helpful to people. I have found that experience is the best teacher, as it is in a lot of things. But it's also, whether it's the Global Investment Letter or something similar, subscribing to something like, kind of a newsletter where you're getting an experienced opinion can be helpful too. I certainly wish I had something like that available to me, when I was a very young investor in my mid-20s. But the internet is actually has been very good at providing access to information like that. I'm afraid I can't hear you.
Can you give some examples of situations where successful investors have overcome biases like overconfidence or like aversion or loss aversion?
Well, I can speak about myself is one of the things that I had to grapple with in my own career was the development of my investment style, which at the outset was highly focused on value investing and fundamental analysis, which is still a component of what I do. But as times changed, as the 1990s rolled on and the internet emerged and so on, I was forced to expand and develop the way I looked at markets in terms of being a bit more liberal in terms of valuation and also incorporating technical analysis more in my market analysis. So I would say the late 90s was both difficult, but also a time of great growth for me as an investor because my investment style and approach, changed in response to the changing times. And that's something that I think that we all have to be cognizant of is that, what worked for an investor in 1989 was not going to work in 1999. And even though things haven't changed quite as much here in 2024, circumstances are different in that geopolitics and the economic factors that are influencing markets are much stronger. The so-called macro influences on markets are much stronger now than they have been, in my opinion, since the end of World War II, which is also reflected in what I'm writing about in the Global Investment Letter, and is certainly having an effect on sort of my own investment positioning and so on.
Thank you. How do successful investors handle mistakes and losses, and what psychological traits help them learn and improve from these experiences?
I think the psychological, to answer the sort of last part first, the psychological trait that I think is key for any investor is to be intellectually curious about the world. That's maybe the single biggest thing that got me interested in the investment field to start with. I was just curious about what was going on in the world, how to interpret events, not only in my own country of Canada, but internationally. And that in itself, I found just intellectually very engaging and very stimulating. In terms of dealing with mistakes and so on, you have to be a bit philosophic or stoic about it and just put it behind you. Take whatever lesson that you can from it, but don't dwell on it, which is not always easy. But don't dwell on it and move to the next one, and take the attitude that whatever I've learned from this position, even if I lost money in it, I can apply to even more profit in the future in my future activities. So once again, these things require practice, and I have to remind myself, even now, to practice what I'm preaching, because we're not always automatically thinking in those terms. But I know from experience that this is the way to deal with things. You just have to put mistakes behind you and see what you can do to learn from them, and don't do them again, which is not always easy, but it's the philosophy to take.
Thank you. Can you share an example of an investor that made a big mistake and he or she was able to take that to much bigger growth?
Well, I watched a well-known fund manager being interviewed, who was at the just before the peak of the internet bubble at the turn of the century, started shorting the stocks because he expected that they were going to fall, and they just kept right on moving. And he had his first real major loss of his career because of that. And I can kind of understand that because I managed money during that time as well. But what he did, recognize his mistake and turned his position around and ultimately made the money back fairly quickly. And that's an example, again, of just being relatively quick to recognize mistakes. But I could really identify with the fellow being interviewed, because that time for serious investors was a tough one, because it was a bubble, markets were completely disassociated with rational investment principles. And so it was a bit of a unique world at that time, and it was very difficult. Anyway, but the moral of the story is be quick to change your mind if it appears that you're wrong.
Thank you. How can investors cope with extreme failure? The reason I ask is because oftentimes you see situations that you really don't want to see, like on the train or, next to a building, there's someone who, saw his failure so badly that, they couldn't live with it anymore. So I wonder, what makes the mindset of a successful investor so much so that he or she is able to cope with extreme failure and still see the light at the end of a tunnel?
Well, that's an important point, and it's something that, to a greater or lesser extent, we've all had to grapple with in in some aspect of our lives. I think the attitude to take is, once again, learn from the actions that produce that failure. Try and forgive yourself for making a mistake or being wrong. Exercise a bit of self-compassion. Don't punish yourself by dwelling on these issues and so on, and attempt to look forward to the future as an opportunity to reclaim sort of what was lost. The other thing too is not to, and this can be hard sometimes, is not to meld your own identity too closely to your career or some other aspect of life. Human beings, we're all a lot more than what our job is or the type of car we're driving or what have you. And while our society doesn't necessarily always encourage that kind of thinking, I think it's a valuable approach to take. And if somebody is really suffering psychologically, emotionally, I think that the thing to do is to reach out for help, and perhaps a third party can provide a perspective that is sometimes hard for us in our own lives to maintain.
Thank you. How does understanding broader market psychology, including the behavior of other investors, play into the strategies of successful investors?
Well, I think it's a key aspect. I think one of the things that I look for in all markets is extremes of behavior, whether it's extremely bullish behavior by investors or extremely bearish. And typically, those are signposts for me to start being attentive to a potential change of trend. Because when everyone is bullish about a stock or a market, eventually they're going to run out of people to buy the stocks or the bonds, and that's when you're more apt to get a change of trend. The other thing that extremes of, let's say, bullishness does is it creates complacency among investors. And that complacency can be very dangerous if the notions that the consensus view gets challenged, and it becomes very jarring emotionally, and that is typically sets up very sharp market declines and so on. Conversely, if everyone's very, very bearish, so you can find nobody that wants to buy something, that's a time to start looking to see if there's some merit in actually taking a position. One of the things that I do, though, is after I've identified those extremes, I wait for the market to kind of tell me when is a good time to buy. And that's what I call it, market price action. And so look for the behavior of the market to provide me with a clue in terms of when to take a position. Investor sentiment is a major factor in sort of forming an investment opinion, because at the end of the day, which goes back to the topic of our conversation here, human psychology drives markets, both in terms of our individual actions, but also collectively in terms of how markets move.
Thank you. How does the ability to delay gratification contribute to long-term investment success?
Well, I mean, I guess that's obviously a very individual decision depending on our unique circumstances and so on. If you're somebody just starting out, or if you're somebody with modest investment funds, and you want to grow the nest egg that you have, you're much better off not buying that more expensive car now and investing the money that way. So it does come down to individual circumstances. Try to live within your means is a good way to put it.
Thank you. Do you think the get rich quick mentality is one of the biggest psychological pitfalls for new investors?
Yes. It's also, once again, it's also a very human uh, attribute. If you have a choice between getting rich slow or getting rich quick, we're all going to want to get rich quick. The problem with that is rarely, rarely do those types of situations really occur. And what it does is that for people getting into the get rich quick approach, it tends to blind them to the flaws of the investment or whatever their opportunity that they're pursuing, because the very notion of get rich quick, it creates a very strong emotional response, mostly of greed, and that tends to blind people to risks and so on. So, get rich quick, or, the old saying is, if something seems too good to be true, it usually is.
Thank you. How important is adaptability for successful investors, especially in the face of changing markets?
That is that's right up there, in my opinion, very, very key. And I kind of touched on that in talking about how my own investment approach has evolved over the years. So being adaptable and growing is a key attribute. Certainly if you look at the state of the world and the state of markets today versus what it was, let's say, 30 years ago, they're dramatically different. It's a much more complex investment environment that we're operating in now, and we have to adapt to that. And I touched on the fact that the geopolitical aspects of investing and what's going on in the world, and also the economic aspects in terms of the resurgence of inflation and very high debt levels among most developed countries and so on. These all create factors that influence markets that, if not now, will certainly do so in the future. And that's why I've been writing for some time about the fact that I think the 2020s as a decade is going to become known for its market volatility. And certainly, we're only in 2024, but certainly the first 4 years have certainly shown a good deal of volatility. And I think that the next 4 or 5 years, the balance of the decade, is going to perhaps even be more volatile. And while that might be a bit concerning for investors because volatility tends to be associated with risk, I also have learned that volatility also produces some great investment opportunities because it does create those extreme positions that offer great risk rewards. So while I am concerned about the state of the world on one hand, I am also somewhat excited as an investor for the next 4 or 5 years at the opportunities that the volatility is going to present. And that's part of being adaptable to change as well.
Thank you. What are the dangers of overconfidence, and how can investors stay grounded?
Well, we all suffer from overconfidence at times, and I have at times in the past where things are going particularly well. I can find myself feeling overconfident and saying, "Oh, what a smart lad I am," and so on. But the thing about markets is, inevitably, they are a lesson in being humble, because however bright you might be and however well things are going, inevitably things will go awry, and not every position or will work out. So there's a lesson to be taken from that. I guess the other thing is to try also, and I'm better at that now than when I was young, is try also just not not to get overconfident to start with, and to be aware that we're living in a very uncertain world and that you can't take things for granted, and that no matter how smart anybody is, the market's going to be smarter at times. And so try and stay humble. And as I say, if you're investing for any length of time, the market's going to give you a lesson in humility eventually.
Thank you. Can you share some habits that successful investors use in order to stay informed and ahead of the curve?
Well, I think reading is number one. I've never met a good investor that did not read a lot, not only about stocks or bonds or whatever, but also just what's going on in terms of current events, and both in terms of their domestic markets and internationally. So the Global Investment Letter is something that I found that some subscribers have come to for their once a month sort of dose of analysis and opinion and so on. But there are other sources as well. The only thing is, I also think that you have to develop a habit of being a bit disciplined in terms of what you're paying attention to, because there's a flood of information and opinion. And while I've always been very keen on learning facts and information in general, I am much more skeptical or dubious about opinion, particularly in this day and age of social media. There are people that will offer opinions about various things without necessarily any background in it, whether it's like health supplements or what have you. So I would say consider the source of the information that you're receiving and so on. But to me, reading is by far the number one requirement for being a successful investor. That, combining that with experience, I would say that's probably 95% of the task right there.
Thank you. How do successful investors stay resilient during downturns and financial crisis?
Once again, that's not always easy, because everyone has an emotional and psychological side of themselves. And particularly in the early days of somebody's career as an investor and so on, can be harder because they don't have that wellspring of experience to count on. The only thing I can offer is that, as human beings, as humanity, we've been able to, make it out of the caves and get through 2 world wars and the recent COVID pandemic and so on. So things move forward, even though human history tends to be, filled with, steps back as well as steps forward. So attempt to stay objective, to recognize that whatever is happening, this too will pass, and that things will normalize. Try and practice the risk management techniques that we talked about earlier in the conversation, which will go a long way to helping preserve our emotional stability by minimizing losses, and to recognize that all these things will pass, and try and learn from what you're experiencing now, and try and make it a profitable experience for the future.
Thank you. Is there any particular mental framework that you've seen has helped investors endure tough times?
I think that to recognize that, the tough times have always been with us, that things have usually been much tougher in the past than they are now, to look for ways to, once again, minimize, losses. The other thing, too, is that if somebody is feeling very emotionally or psychologically unsure or unstable, you don't have to be investing at any point in time. You don't have to be in the market. You don't have to have any money at risk. You can always just sit on cash until you have a good idea that comes along. And that's one of the things I've learned as well, is that you're much better off, waiting until the odds are in your favor, so to speak. That's one of the things that's a fundamental aspect of what I do, is I try and think in terms of probabilities as opposed to, just feelings and or emotional response, emotional responses. And if you think in terms of probabilities, not only does it serve to improve your odds of being correct, it also discounts the emotional input that you put into making your decisions. So a lot of these aspects of investing tend to come back to a few core concepts, and even the ones that aren't core, they're all connected in one way or another, as markets are.
Thank you. Tell us more about the Global Investment Letter and how many hundreds or thousands of people has it impacted, and what were the impact? What was the impact? What were the results for those people? If you have any sort of like case study or anything, any facts that you can share.
Well, I started writing the Global Investment Letter of 2017, and that was in response to people inquiring about whether I offered a paid version of my comments that I was putting out previously on LinkedIn. I had started in the year or so before just to post my general comments on LinkedIn, which ended up getting a surprisingly positive response, which led to me starting the Global Investment Letter. And now the Global Investment Letter has got subscribers on all the continents, except, of course, for Antarctica. And its focus is global macro in terms of I look at all the major stock, bond, currency, and commodity markets. It's published once a month. And it's created a very nice community of investors that will provide me with feedback and at times with sort of what it's meant to them and their own ideas about things and so on. And it's been a very positive experience for me from that standpoint. It's also allowed me to share sort of my hard-earned experiences over the years to other investors. And the people that are subscribers are typically they're hedge funds, they're other money managers, whether it's mutual funds or whatever, high net worth individuals, family offices, professionals, physicians and lawyers and so on, or anyone, or other people that are serious, active investors. And it's been a very gratifying journey for me. And it's been nice to see also how the Global Investment Letter has evolved in terms of how much better I am as a writer now, as opposed to, let's say, the first couple of issues. I mean, the content was good, but my writing style has developed a little bit, and the results have been very good. I mean, I touched on the fact that I was able to alert people about the COVID crash, ahead of time. Been able to identify various opportunities and so on in stocks and even currencies and gold and some industry sectors. So my investment results, continue to be quite strong. And in fact, I'm sure I'm probably a better investor now than I had been in the past, just by virtue of the accumulated experience that I've had. So it's been it's been a very pleasant journey, and I'm also excited by we talked about sort of my expectations for markets for the balance of the decade being very volatile. I think that's going to make navigating the markets even more interesting. So I'm looking forward to the next, 5, 6 years in the global investment ladder in terms of how markets play out and so on. We're living in troubling times, but they're also fascinating on a lot of levels as well.
Follow us for more interviews with world's most influential business titans, providing you with the insights to awaken to your full potential, so you can get paid to be yourself, find true happiness, and manifest anything you desire.